Trading is more of an art than science. Have you ever heard of that term before? Because I have, and over time of my trading and with my strategy, I've kind of come to terms that that's not really the case. So stick around, and this way you can understand why. Welcome to Trading Without Fear. Just before we go ahead and move forward, I just want to let you know I'm not a financial advisor. Any tickers or any information that I talk about are my own opinions. They're meant for educational purposes only. Understand the risk before you enter into any trade, and let's go ahead and move forward. So think about it like this. On your day-to-day lives, we actually have this tendency to actually wake up around the same time every day. We eat around the same time every day. We go to sleep around the same time every day. And if you're excluding work activities, because a lot of people will say, well, I have those routines because I have a full-time job, and that's probably true, but something outside of the job is your own love life. Humans are so routine that even our love life is routine-based. So humans are so predictable that software has been developed to actually predict based off of past data of how we're going to behave in the future. So using predictive analytics, Amazon has the capability of knowing what you're going to be purchasing even before you do and even before you even purchase it. So new traders who are trying to become consistent in trading stocks, they oftentimes will seek out information or techniques to actually help them save money that they've already made in the market. So over time, with conviction, they actually change their state of mind and how they perceive market information. So charts are the collective minds of all the traders participating within that market, and the charts are basically showing us the hands of each individual trader within those markets. So chart patterns only provide us with a possible outcome, and many people actually call these market inefficiencies. But in reality, they actually provide a very predictable outcome. So it's really no different than like playing a card game, predicting a natural disaster, or even winning the lottery, pulling the handle of a slot machine, or in basic terms, flipping a coin and calling it in the air. So one of the reasons why people say that trading is more art than science is because reading a chart comes from your own interpretation. So art is subjective, and this is very true when it comes down to market data and chart reading. So our psychological state of mind will actually project our wants, desires, and fears onto the chart. So the so-called market inefficiencies are actually very predictable outcomes. And the reason behind that is very simple. It comes down to the traders. Every trader, regardless of position, whether long or short, plays that trade for the exact same reason. What's that reason? Well, they want to make money on the trade. So technical analysis is not the issue, and it's not the reason why you're not consistent within the markets. Because it's not because you don't have the right indicators like, VWAP or unusual volume or trading averages or RSI or any of those type of indicators. What it comes down to is a very real human problem. So the sooner you accept that, the sooner you can actually change your perspective and evolve your state of mind so you can become more consistent within the markets. Now, if 90% of traders actually lose money, why do people trade in the first place? It's for the same reason why people gamble. It comes down to random rewards. And one of my past videos, I just discussed of how our brains are actually wired for random rewards. And so some people actually trade it because they're actually addicted to the random reward scenario. In other cases, it's the same reason why people smoke cigarettes. Even though there's actually a warning label that says that cigarette smoking is actually hazardous, they do it because they don't feel like the rules apply to them. And taking in consideration of like this, you may know somebody or see people on Twitter where they only have a few years of experience or maybe even maybe a year to 5 years of experience, and they're consistently doing the same things over and over and over again, making the same excuses why they're not in a trade, or making the same excuses why they took a huge loss in a trade, and they're not really progressing their state of mind. And when you try to reach out to them and help them, if they're, if you can actually guide them a little bit further, maybe based off of experience, or even making the same mistake and how you actually corrected that mistake, and they come back with you of stating, this is what I'm doing for now, and I'll be doing something later on in the future. They basically have this belief that the rules don't apply to them, that whatever success they're going to actually find comes down to what they did right versus what works. And if you look at a lot of the traders that are successful, it doesn't matter who you're talking about, what they did is they followed a mentor strategy, or they actually followed somebody else's strategy who was successful. Even if you look at my own strategy, now my strategy, I learned the patterns from Tim Sykes and from Nate from Investors Underground, but my trading execution comes down to my own unique system, and it's how you execute trades that makes you a success or a failure within the markets. And based off of how I'm actually trading, it's following their teaching, their way of actually gaining success, which means I will be successful in the future as well. Now, not a single person on the planet can say with 100% certainty or accuracy that they know exactly where a stock is going to go in the market. And if they do say that they know what the stock is going to be doing, that basically means they have an emotional invested interest within that stock. So let's say if you bought Dogecoin and you bought it at 50 cents and somebody asked you, what do you think about Dogecoin? Would you tell them that you believe that the Dogecoin is going to go down? Their opinions are basically based off their own wants and desires from the market. So you may have actually heard people talk about taking advantage of market inefficiencies, and what market inefficiencies means to me is, from a psychological standpoint of view, is a random outcome. Simply put, it means probabilities. So the stock chart gives us, as technical traders, the ability to see what the collective minds of the markets are actually thinking, but you also have to be fully aware of how the human brain works. Now, our minds are our worst enemies when it comes down to trading. Now, don't believe, not even for a second, that any chart or indicator is going to give you a certain outcome. The problem is human brains have adapted for pattern recognition. Now, this was actually a way for us to protect ourselves from past mistakes and link those past mistakes to potential future events. Apophenia is a human tendency to actually to recognize patterns and basically noise or even randomness. Now, when you're actually thinking about markets and trading, all traders have the ability to actually see the same patterns, see the same indicators, and even access the same indicators. So my argument is, if 90% of traders are losing, then it must come down to the way that they think. They're basically thinking like everyone else. The equity curve is your reflection of your own state of mind. Now, we all seek out information that validates our beliefs about ourselves and our desires from what we want in the future. Now, if our beliefs about ourselves don't actually align with what we desire in the future, we'll actually self-sabotage what the outcome is to further the belief and the notion of how we actually feel about ourselves. We all seek out information that confirms what we believe, we want to establish about our beliefs. Then our behavior is actually driven by our state of mind. So all market inefficiencies are a reflection of the collective state of mind within the markets. Let's go ahead and look at this chart of MRIN. So I've already established that people are very predictable, and people will also react in a very specific way. Now, by no means am I saying that you're not going to be able to take a loss. Losses are a part of trading. Human behavior may be predictable, but there's also some outcomes that are not necessarily random. Even on a broader scale, they're still part of the probabilities. For instance, everyone's actually worked with somebody who, it seems like almost one time a month, they're actually going to take a Friday off of work. You don't know what Friday that's going to be, but you just know that they're not going to be there. That's kind of the same way that patterns work within the markets, is you don't know what scenario each pattern is actually going to play out in your favor and which patterns are actually going to reach your sell target, but you do know that there is a certain percentage of patterns that will fail. So expect that you're going to actually take losses. So if you even think about it, taking losses is even a pattern within itself. It's a very predictable outcome. If you have a system that you're winning, let's say 70% of the time, the other 30% is a pattern that says, I am going to take 30% times I'm going to have losing trades. So that is a pattern, and that is a very predictable outcome. Trading is no different than actually flipping a coin and applying money management. So in my belief, it comes down to about 80% psychological and maybe 20% actual art. So leave a comment below. Tell me what you think. Do you think trading is more of an art, or do you think it's more of a science, and why do you think that way? This is it for this video, and we'll see you next time.